Hey everybody, it's Dave and RJ with The Cream. If you're new to the channel, The Cream is for cash flow, real estate, and money. That's what we're all about, is building wealth, maintaining wealth, and helping you build wealth. We love real estate, and one of the tools that we use within our real estate investing business, and a lot of our private lenders use actually, is a self-directed IRA. And we have with us today Mr. Juan Deshawn. Juan Deshawn is with Quest Trust Company, who is the custodian of choice for RJ and I. We have our own self-directed IRAs with Quest, and Juan helps us facilitate a lot of transactions. He's there in the corporate headquarters. How are you today, Juan?
Doing well. Thanks, Dave. Thanks, RJ, for having me. Yeah, I'm over here in Houston, where we're based out of, but we have clients, of course, nationally, so no problems. If you're watching this from different places, no worries.
Quest has been great to us. We highly suggest checking them out if self-directed IRA investing is something that you're interested in. I think if you're not interested in self-directed IRA investing, you will be interested once you start to learn some of these benefits. It's a very powerful tool to have in the tool belt. And of course, it wouldn't be a Cream interview without my main man, RJ Pepino. RJ, how you feeling today?
You don't know what self-directed IRAs are. What are you doing? What are you doing? I'm feeling good today. Thanks for having me on here with Juan. It's good to see you again. I know we run across each other here, run into each other here with the masterminds that we're a part of. So yeah. I'm excited to talk about this particular subject today, because I think a lot of our viewers and listeners want to be able to transact in certain ways, like what we're going to talk about.
Yeah.
Two investors into a deal. So excited to be what we're going to be talking about. So Dave, back to you.
Well, let me add something there too. I want to also mention for those viewers, I'm not being paid to do this, and I'm not paying them to have me on here as well. Everything we're going to go over is not what Quest can do. That's where I work for. Just full disclosure. It's what you can do with IRA accounts. I want to make sure that these rules we'll talk about and strategies are across the board, if you're anywhere in general.
And we're going to go deep today. If you've been on the channel for any amount of time, you probably have saw us do other interviews with representatives from Quest, because we genuinely enjoyed working with them. And if you're new to the channel, make sure you hit that subscribe button. We appreciate it. We try to add as much value as we possibly can. Hit the notifications bell. Leave any comments, any questions you may have in the comments below. And we're going to be getting a little bit deep today. So in previous videos that we've done, we've kind of talked about the mechanics on what a self-directed IRA is. Today, we're going to talk a little bit more about how to use it in somewhat of an advanced strategy. And we hear this all the time, from our own students and just other investors. They say, look, I have an IRA, I have a self-directed IRA, but I only have a limited amount of funds. I don't have a lot of money. I would like to, use this for real estate flips or real estate lending deals, but I only maybe have $10,000, $20,000. How can I somehow add other people to this deal? How can I somehow, be a part of the deal with my limited amount of cash, but still get deals done? Well, that's what Juan's going to get into a little bit here today. And we're going to talk about utilizing trusts. And sometimes people's eyes glaze over when we start to get into asset protection, estate planning, trusts. This sounds extremely scary. It's not scary, everybody. Just hang in there. We're gonna keep it as simple as possible, but this is gonna be really teaching you the opportunity where you can get involved in real estate deals, even if you don't have a lot of money in your self-directed IRA. So Juan, let's start with you. Kind of give us the format and the platform here of what we're talking about on how multiple people can get involved in a deal using their IRAs and trusts.
Yeah, so we get the question a lot is, like you mentioned, how do I utilize these retirement accounts when I don't have too much capital to work with? And it kind of stems back to what's probably in the basics presentation. So if you haven't seen that, watch it. But what we call OPI, which is other people's IRAs, using other people's money to make deals happen. Use other people in your network to make deals happen. I've used people in my network. I know RJ and Dave do things together because they're in each other's network. So how do we partner those funds? It's kind of a basic term that we use. We're partnering those dollars with an IRA accounts. That just means that if, let's say, theoretically, we have a deal that costs us $100,000 and we only have 25 grand. But I know individuals that may have enough funds to kind of make up the difference. Let's say I have 4 other people. We can all, just to make math easy, go in 25% each person, 25, 25, 25, 25 to make my full $100,000 to make up a loan, a note, whatever it may be. That is considered partnering. Now that can be done without an entity like a trust by simply having the IRA send money to the individual, and that individual pays out each individual IRA when it comes back. Now, in situations like that, it's very, very easy, very straightforward. But when things get very complicated, or you want a little bit more control, you simply don't want to pick up the phone and call your custodian every single time you want to make a movement, you can utilize the trust example. Having an entity that's what we consider pass through is a trust, or even an LLC in times, but we'll just stick on the trust side of things, will allow you to consolidate that money from each individual person and utilize those funds as one for that single deal. And then you can rinse and repeat and constantly use that money that you gain from the profit to maybe do your next one and your next one and your next one. And each individual involved has a certain percentage of interest in that deal. Let's say in this case 25%, that ends up paying them back eventually when they're, I say that trust no longer does deals anymore. So that's kind of the most basic way I can kind of explain how to use the trust example within partnering accounts without getting too much detail, which I'm sure you will. But does that make sense?
Yes. So we got 2 choices here. Let's pretend, there's me, RJ, and 2 other people, and we find a house that we want to buy for $100,000, or a loan that we want to do for $100,000. And RJ only has 25K in his IRA. I only got 25K, and our 2 friends only have 25K each. Now, what we could do is all 4 of us lend the money. We send the money to the title company, and the promissory note is written in such a way where 25% undivided interest for RJ's IRA, 25% for Dave's IRA, and then 25% each for our 2 friends. And then the borrower, if this was a loan, essentially would have to make 4 interest payments every single month. If that's the way the note was structured, they would pay all 4 of us our equal share of the interest. But what we could do with trusts, it makes it much more simpler. And when it's more simple, it saves us money in fees, because if we did it the first way that I just described with all 4 of us, all 4 of us would have a certain amount of custodian fees. Is that correct, Juan?
That's correct. So ultimately, by consolidating them all together, you eliminate the transactional fees every single time there's a payment, money leaving the account, a new transaction being made. On the front end, the investment to the trust, you have to get the money in there somehow, right? That is considered one investment. So fees wise with custodians, you're still going to see a fee there. Where it saves you is more so in the long run, where if after this note, you did a second one, you're not repaying another fee to do a brand new note. You're now just using that trust where you have the funds consolidated to do everything else, which does not deal with us anymore. So we're not going to charge you for it anymore. So it kind of helps you with the fees on the back end, not necessarily on the front end, because you still got to get the money in the investment somehow. So there's still a charge there, but not in the back end. Is that your question?
Yes. So the way this works is we use title companies to prepare our notes and when we're doing real estate transactions. And essentially, we find this deal, we find this loan that we're going to do. We're going to lend the money, a hard money loan, something like that, all 4 of us, back to our example. The title company creates a trust, which is nothing more than just a piece of paper. It's a pass-through entity, right? This entity, this trust, is not going to have to file a tax return. Is that correct?
Yeah, sorry, I thought I was on mute. But yeah, no, absolutely, right? So now I'll say this is a good time to say I don't give tax legal investment advice. However, yes, the trust is considered pass-through. There's not too much there's not really anything has to really report. It's just, like you mentioned, it's a piece of paper. If you've ever seen a trust agreement, the document says who's the trustee, who are the beneficiaries that are taking, what the funds are doing things for. That's really all it is. It's consolidating all into one separate bank account. Now it is considered an entity, so it does have its own separate EIN number for the purposes of setting up checking accounts, etc.
So we create this trust, which is just an entity. And the beneficiary, there's 3 parties, well, 2 parties really, 2 main parties to any trust. There's the trustee, And that is the person who's actually going to be on public record. And then there's the beneficiaries. And in this scenario, for this trust that we're creating for the sake of pooling our money together, essentially for this loan, the trust beneficiaries is going to be my IRA, RJ's IRA, and our friends' IRAs, right? And the trustee is not allowed to have a dog in the fight, right? The trustee is not, their IRA is not allowed to be part of this deal. So it needs to be a completely separate third party. Is that correct?
Yeah, and to dive a little deeper and to explain why, very, very briefly, is going to be the IRS does give IRAs rules on what they cannot invest into. And simply put, you cannot invest into entities that you yourself, as the IRA holder, manage, control, own, etc. In this situation, if you put yourself in position as trustee, you are going on public record that you are managing and controlling this entity. So you can see how that falls in line directly on what the IRS does not want you to do. So what happens here is, as an IRA holder, if Dave and RJ are going to be the beneficiary, or their IRAs, I would say, are their beneficiaries, well, then that eliminates them from being trustee. That doesn't mean they lose full control. At the end of the day, it is their money, and I'm sure you guys would choose a trustee that you trust and know, and you could probably call on your cell phone if needed. But they're there on public record as being that kind of, think of it as a middleman. The IRS wants you to go through some kind of middleman, but this one's a lot easier than a custodian. I'm not going to charge you fees either. So that's kind of the way around that situation. So just appoint someone that's not part of the beneficiary list as a trustee. And I would just encourage to be someone that you trust and know and you can contact. But that's the way to get those monies in there. That's correct, Dave. For that, there's two types of people.
Got it. So then we send the money, then we would send the money right to the escrow company, right? And we would inform you, the custodian, on how this trust, on how the funds are going to be allocated when the note gets paid back. You guys need to know that too, right?
Yeah. So as a custodian in this situation, we would already have copies of the trust agreement. We want to know what's going on, who are the beneficiaries. So in this situation, there's 25% each person in 4. And so we understand already, just based off a trust agreement, that anything that comes back and that's going to be from that trust is going to be 25% split. So we automatically know, if all the 4 people are with us, we automatically know that $1,000 payment coming in should be split 25% each. That makes it a lot easier on your borrower in this case, because they're not worried about if there's 4, 5, 6, 7, 8, 10 people in the trust. It doesn't matter to them. When they receive the money, they're receiving it all as one lump sum.
Now, when people hear things like, pooling money, I hate to even use that phrase, right? But like when people are partnering on these deals, I already know people are going to be asking us like, hey, don't you got to file with the SEC? I mean, is this like do you need a PPM? Do you need to register with the SEC here? Like, do you get those kind of questions at all with these kind of partnership deals, Juan?
We do get the questions for deals that are much larger scale of situations. And that's kind of where it comes into play, right? You really need to do those things if you are a large organization about to do a very, very large transaction. At that point, then you start to file all those legal paperwork and documents. But something very simple, like a just straightforward promissory note on a single family home to a private borrower using private lenders is nothing that they need to file for. Your homework or your diligence as the lender, or lenders in this case, should contain that you have done your own check on the borrower and who they are. And that can be anything you guys choose. It can be simply you guys go get coffee, and if you like the person, you're cool with lending them money, okay. Or it can be you can ask them for the credit, you can look into more information, but that's on you. It really is, everything's on you or the lenders in this case. So nothing you have to report. It's a very straightforward transaction. Lenders should do their own homework and diligence to make sure they're comfortable. And borrowers, if you're borrowing private money, you should make it easier on lenders to make them feel comfortable to loan you funds. Because I guarantee you that as soon as you find or do one deal with a private lender and everything goes right, they're calling you next week to say, do you have anything else? Right.
This entity that we create, this trust that we create, it does need a bank account as well, right? Because the proceeds come out.
Yeah, so in this situation, you would need a bank account. And the reason being is because as a custodian, we got to send the funds somewhere. In this situation, if you want the trust to be the lender, not the IRAs, because the trust has consolidated all the funds, that trust is going to send the money to the borrower, and the borrower is going to pay the trust. That's all they're concerned with. But us as a custodian, we got to put the money inside of the trust. Where does the money go? Got to be some sort of checking account. That's why you go online, irs.gov, and just get an EIN number for your trust. And at that point, a bank can open an account for you. They're usually free and very, cost efficient. And that's where we would send the IRA money to. Moving forward, let's say you now have $100,000 in ABC trust that contains money from all 4 different individuals. That trust will loan that $100,000 to the borrower. Those payments will be made back to that trust's checking account. Does not go back to your custodian. And then the convenience of this is, let's say you don't want to pay out those IRAs just yet. You've now gotten your return. And let's just say you made a killing, you made $150,000. Now that's all back in the trust account. Instead of sending that right back to all the IRA accounts where each of them owns 25% of that, you can just rinse and repeat and do it again and send the funds right back out to another borrower, another deal, another property, all through the trust and all through the management of that trustee who you've appointed.
So what I'm hearing is when there's multiple partners in a deal and IRAs are involved, using the trust will keep things simple. Simplicity is the thing, and it lowers the fees, and it keeps it simple for the borrowers. And it probably keeps the promissory note pretty simple as well, right? When the trust is actually making the loan.
Yep.
RJ, what questions do you have?
So if we have people that have never done this before, how easy is it for you? Do you guys help that through that transaction? One, I mean, is it something like, is this like I'm brand new, but I have like 2 or 3 friends that want to do this, and we approach Quest.
Yeah.
What does that look like? I'm thinking in the minds of somebody new, this might be too high level, but they want to do this. How can they, like, what do they need? Like, what
So we would approach the situation from the standpoint of the concern of your IRA. That's where we're going to be concerned with, and that's what we're going to look at. So we'll take a look at what you have, and you let me know kind of the situation that you have in mind. And if you bring up, okay, I want to put it on a trust, well then perfect. But the thing is, we'll tell you, you need to set up a trust, right? There has to be a trust. We'll let you know that beneficiary can be your IRA account or multiple, but the trustee's got to be someone else. And we'll tell you exactly who it cannot be based off of a few questions. And then once you figure that out, unfortunately, custodians like us, we don't set up trusts. We're not in the business of doing that. So simply you do that somewhere else. I mean, that can be either done online, you use an attorney. There's ways to get trusts created.
Title company for a lot of our guys. They're real estate guys. We use the title company. There's an attorney there.
There you go. So very simple to do. And once it's established, as a custodian, the only thing we need is, okay, now that it's open, we need a trust agreement. We need to see that the actual IRAs are part of that, are the beneficiary in order to send funds, and then we'll do so at your discretion, of course. So it's a very simple movement. It is actually very straightforward, and we'll prepare you with what you should not do. As a beginning investor, this is maybe a high-level move to do, right? As a beginning investor, if you don't want to create more entities and create trust, so that's just a hassle for you at the moment, and you're a viewer right now, and you say you have enough in your IRA account, or you have enough between you and another person that you know, now, and you're only looking to do 1 deal a year, maybe you can do that within the IRA account without the trust as well. That's still an option, but this helps you consolidate funds in one single place and then continuously rinse and repeat those funds and lowering your annual cost as it comes from administrative fees from custodians. That's why the strategy is looked at very often.
So we love Quest. I mean, they walk us through. This is where we learned a lot of these strategies and techniques. They do everything by the book. And, RJ said it before that the tax code and, this stuff is written for real estate investors. And self-directed IRAs is just another tool in the tool belt, a very powerful tool. And we've done previous videos, kind of the basics of what the IRA is and whatnot. I kind of wanted to touch on, I think it's a great time. I mean, the S&P 500, NASDAQ, Dow Jones, everything's hitting all-time highs in the stock market. Probably not a bad play right now to help your private lenders. Like, hey, set up a self-directed IRA. And if they got money in an IRA in the stock market, not a bad time to sell. I mean, it is feeling awfully frothy out there, to use Wall Street terms. And, if they sell this stock, I mean, they're selling at these all-time highs, transfer that money over to Quest, and they could be a private lender for you now. It's secure their money against collateral with real estate. This is what we do. A lot of our private lenders have sold a lot of stock over the last 12 months. And now they're getting that money working with us as private lenders. But Juan, great talking to you as always. RJ, any final thoughts for our viewers?
We appreciate you, Juan, and also the team at Quest. And I'm sure we'll be working with you guys here soon again.
Yeah, no worries. And listeners, what I'll mention is subscribe to the YouTube channel. It's got a wealth of information that's right there and free for you on YouTube. Put in the comments, contact Dave, contact RJ. They have my personal contact information. So if you guys have any questions that weren't addressed, or you just want to touch on things one-on-one, always happy to help. You don't have to be a client to do so. The best thing is to do your homework, research these things, learn, but don't forget to apply it as well, because you can learn the whole world, but if you don't do anything, you're just gonna sit there, right? So yeah, so I think we guys are doing great, and I say also subscribe to y'all's channel. So
Excellent, Juan. Thank you, RJ, and to all of our viewers. You know where to find us. It's the Cream Cash Flow Real Estate and Money, and we will see you on the next video.